Hello, traders. It is Wednesday, June 12th. We've got quite an exciting market today. Please welcome Harry. He's on as well. Harry, I hope you can hear me. And any event, we're going to take a look at the previous trades that we did. Stop muting me. Yes, so Harry's not going to have a video feed, I believe, today, but I will have mine. And we're going to start with a review of our previous picks, and then we're going to take a look at the market. We've got a lot of action today with the market making a new all-time high based on that CPI report. So we'll get into that. AFRM. That was a bearish call spread that I showed you Sunday in my video recording. And we'll take a look at the D1 chart. Love this downward trend and the fact that the stock had not been able to get above major support, resistance. So these were the major moving averages. We had the 200-day moving average, AVWAP-E. Everything looked good for the stock to continue to drift lower, and my market opinion was neutral. So I was looking for an opportunity, given that the market was at an all-time high, to sell an out-of-the-money call spread. And look what the stock did. It had news that it was going to be added to Apple Pay, and that sparked a big rally in the underlying stock. I didn't adjust the position yesterday because I wanted to see what would happen with it into the close. Obviously, it was strong. And then today, with the market being up massively, it also rallied. So I did take a short position in the stock to mitigate some of the losses that I had on that call credit spread. And I took a 20-cent gain, but I also did a trade in this account as well. And I was able to make, here you can see that I shorted the stock at 38.31 and I bought it back for 36.53. So I was able to make back more than my losses. I think the stock's going to continue to pull back. So I'll continue to day trade the underlying stock. Very difficult to leg in and out of spreads when the bid-ask spread on the options is so high. And the other trade that I had from a week ago was Qualcomm, and that one's actually done fairly well. And then we'll take a look at Harry's trade. You can see this is where the live event came out, and the stock is able to get through this little horizontal resistance level and is trying to break out of this compression. Harry, let's take a look at your trade. What did you have for us last week?
probably right now frantically being shoehorned into Powell's post-presser speech, right? Normally those speeches are worked on, and by the night before, they're practiced, they're polished, they're done. His answers are practiced. He knows what every question's going to be pretty much, and that's why you get these kind of very bottled responses, because they went over it 1,000 times. Now you're injecting this brand new piece of information, this brand new piece of data into today's announcement. How's he going to react to that? Is it going to be a little bit more off the cuff than usual? Obviously, what everyone's going to look for is, does today's CPI turn Powell and the Fed a little bit more dovish and a little bit more likely to cut rates sooner and with more magnitude? So that makes it interesting to see. A very rare thing today where you have that major economic release and a Fed decision both in the same day.
Yes, I tend to think that they're going to stay pat on what they've been doing. We'll see. You know, I'm not positioned ahead of the number, but given the big gap up right now, I think that good news is absolutely priced in, and I think the Fed could splash a little cold water. Yeah, we're happy with the inflation starting to ease a bit, but as far as cutting rates, we don't really see the need to, because we've got decent economic growth. And we had ISM services came out at a very robust reading, above 53 last week. We had jobs come in at 275,000, also very robust job growth. So the Fed is in a great position right now. They have accomplished their objective, which was to have inflation come in, and they've still got a strong economy. So their actions have not cratered economic growth. And that was the fear a year and a half, 2 years ago, was that this super round of tightening was going to push the economy into a recession. So we'll see. The market certainly has a nice break here, a new all-time high.
I think there was some problem in my audio earlier, so I don't know what people missed or didn't miss, and I probably can't remember what the hell I said anyway. So, but I'm sure it's
it was
fine.
All good information, Harry.
Great. I mean, PTLR up 10% since I mentioned it, and my next pick is probably going to be Microsoft for this coming week. And if you look at my positions, obviously I'm bullish. I'm long Microsoft. I'm long MDB. I'm long Shop. I'm long PTLR. I am long SMCI. I'm long MSTR. I am long Melly. I am long NVIDIA. I'm fairly long here. And now that I say it out loud, I probably should put a short involved. But yeah, at the moment I'm bullish. I do agree that the Fed may put a little bit of a damper on today's pop. I mean, unless Powell's going to come right out and be like, "Damn, I was blown away by that," and we're just ready to slash those rates. You know, it seems like they're pricing in, as you said, all the positive dovishness that they possibly can. I'm not even sure he can meet their expectations of how dovish they think he'll be here. But, you know, you can only have inflation dropping so long and the economy doing well for so long without an immense amount of pressure coming on saying, hey, why the hell are you keeping rates so high? So we'll see what happens there. Anyway, it's definitely a interesting time. Particularly, this is usually, you know, you're heading into the summer, and we're right at an all-time high, which is always there. You know, stocks. I like stocks at an all-time high because there are no bag holders up there, right? So it can keep going, and anybody who's in it is in profit. But when the market is at an all-time high, which is a slight difference there, there's always a danger of a technical pullback. And we've hung around this all-time high for a decent amount of time, so we might be ready to break through, but it's still always a little bit of caution that should go into your trading. Of course, I say that after I just said I'm long every damn stock in the market, but a little bit of caution is probably a good thing in an all-time high area.
there's really no reason for the market to sell off outside of profit taking, which normally you're not going to see just wham, a lot of profit taking, everybody deciding to hit the exits at the same time. That's not typically what happens, but you will eventually float higher to a point where you'll see some profit taking coming in. And this is largely program driven, in my opinion, the last leg of the rally. And I say that because you can see how light the volume has been during the course of this last part of the rally. So when you start seeing really tiny bodied candles like this and the market just floating higher, we could see that throughout the month of June and perhaps even into July. But those moves are very vulnerable to a nice big pullback. So there's no real reason to be short in here for sure.
I mean, yeah, it's an interesting question because, you know, to think, and then I'm writing this article now on how institutions think. And, you know, if you're thinking like a retail trader, right? For example, I'm long NVIDIA. I got in at what would have been, if you take the split, 120.90, right? So I'm up around close to almost $5.50 on the trade. So thinking as a retail trader, it's like, okay, this might be a good place to take profit here. All right. So as a retail trader, perhaps I'll take some profit. Perhaps I'll do it before the Fed announcement. But if I'm an institution, and now remember, institutions make up a bulk of the liquidity in the market. And why does that matter? It matters because liquidity is what moves price. I don't move price. I'll be trading 10,000 shares in NVIDIA. It's $1.25 million of NVIDIA. That's not going to do a damn. It's not going to move a penny of that price. Not a penny, right? In fact, more than 10,000 shares were traded just as I'm saying this. So it's not going to matter. Now, an institution, JP Morgan and Goldman Sachs and all, they can move the price of NVIDIA if they sell. But are they thinking like a retail trader? They're not thinking, oh, I'm up $5 on the stock or I'm up $7 on the stock. They're thinking, this is our target. This is our target for the stock. Maybe it's 190, maybe it's 200, whatever it may be. And the intraday's ups and downs aren't going to bother them. They're just saying by December 31st, we see NVIDIA here. Now, if the market shifts, so for example, Powell comes out and is hawkish or something like that, they will adjust those targets and then they will rebalance accordingly. But they are not looking at, I'm up X amount of dollars, I'm going to take my profit as an institution. They're looking at, here is my target, what's the probability of hitting the target, and does that target shift with market conditions? So, you know, that's what's going to control the liquidity of something like NVIDIA. And then on top of that, there was an interesting thing that was mentioned to me the other day. And these are things that, you know, retail traders just don't think about. For example, JPM tells me that if NVIDIA's market cap overtakes Apple's market cap, NVIDIA and Apple swap spots and weights on the XLK, right, which is the sector. That would generate roughly $11 billion, around 9.6 million shares of NVIDIA to buy, while doing the opposite for Apple. So that would generate that much to sell. And the reference date on that is June 14th to close. So yesterday's move on Apple puts it ahead of NVIDIA with 3.5 trading days to go. But that could explain the outside move. So once it surpasses NVIDIA, a huge expected supply overhang is removed from the market. Apple can quickly go the other way. So now you have this jockeying of position of which is going to have the largest market cap in the XLK sector. And that is actually going to that generates a buy or sell on that because of the percentage it's taking up of those ETFs in that sector. So it's things like that retail traders aren't paying attention to, and nor should they, but institutions are paying attention to. And that's kind of where, you know, you have to see how big the gap is between retail thinking and institutional thinking.
NVIDIA does have a very nice orderly pattern. You can see back in here, and that's a sign that institutions are involved. Every time a sell order comes in, they gobble it up and the stock never dips. That's how you get these very nice, tight, orderly patterns that you can predict. This is exactly the type of pattern that we're looking to trade. So, and I had, I want to talk a little bit about AFRM because, it's a trade that went bad. I would still do the trade. Whoops, let me get the right symbol in there. It's still a trade I would do 100 times over. It's just that there was news that came out right here and sparked that rally. There was no indication that the stock was going to move ahead of time. Oftentimes, what we'll see, and we'll start picking up stocks in all of our searches, we'll see breakouts and heavy volume and relative strength. And lo and behold, we take a position, and then a day or two later, you get a big move. Somebody knew what was happening inside, and they were running, front running. And so we're able to ride those coattails and get in, and then boom, the news comes out. We didn't have anything in here. This was a very well hidden secret, if you will. And then the news came out and it ran. When I saw the stock this morning, though, to have a jump of that magnitude as the market was continuing to push higher in here, you can see how the market is grinding higher. What did the stock do? You started having some tails and some wicks up here. This is also more advanced type of trading style than what we teach in the system. But once I started to see these wicks and that big move and the fact that the stock was not moving higher with the market, I saw this long red candle in here, and then I knew that we had decent resistance. This is where I shorted up in here. And then I did post in the chat room that I bought back for a 20-cent profit. Took it pretty easy in one account, and the other account, I let this drift play out, and I bought it back for, I think, about $1.70 profit. What I'd be looking for if you've got AFRM on, okay, you're just normal trader right now, you've got this spread on that's gone bad, what should you do? Well, the stock itself is trying to get through a second resistance level, which is this 100-day moving average. So it's already gotten through AVWAP-E, it's gotten through the 200-day moving average, nice stuff. It got above the 100-day moving average. So I would just be watching it right now to see if it can hold that. The fact that it's got this long bearish hammer forming right now tells me that the stock might actually poke back below the 100-day moving average, and it could continue to drift lower. The company itself said that they don't see this being material to revenues even into 2025. So this could be some short covering in here because you've had this nice steady downtrend, but these sellers are going to come back, and we'll see if that stock can drop below the 100-day moving average. I'll start feeling much better about just hanging on to that bearish call spread anyway. So I was also on the wrong side of the market. That's not helping either. And my premise for taking a bearish call credit spread was the fact that we had the market kind of topping out right in here, not a lot of advancement. I didn't see that this CPI number was going to spark a big rally. I felt that with the Fed also coming up, that the chances of a big breakout were very negligible this week, that we're just going to trade in a sideways pattern. I was wrong about that. And there were a couple of clues earlier in the week. We had gaps down, and then the market rallied back. Gaps down, and then the market rallied back. Those were signs that buyers were engaged. There's your gap down, there's your rally back. There's your gap down, there's your rally back. So these are signs that buyers were supporting the market down here on this horizontal support level. So for right now, AFRM, I'm just going to be watching the stock to see if it holds the 100-day moving average. Right now, I'm feeling that there's a good chance that it might crack back below it. And then we'll see what kind of follow-through selling we might have. These options are for the July 5th expiration. So I've got plenty of time, and I can trade around this. I'm not going to be legging in and out of the spread because the bid-ask spread on the options is too wide. I'm just going to day trade the stock.
All right, so a couple of things here. One, I took a trade right before this live stream started, and that will be my pick of the week. I traded Microsoft. I did a call debit spread on Microsoft. I did the 440s, 445 call debit spread. All call debit spreads that I do are going to expire the same week, so that's Friday. And did it for $1.83. I took 10 contracts on that for the challenge account. You know, if you look at Microsoft right now, it has everything you want to see basically in a chart, right? You're looking at an all-time high. Love all-time highs, as I said many times. You're seeing a clean break of the both the 50 and the 100 SMAs. You're seeing a breakout today above horizontal resistance. Basically, the chart on Microsoft right now is a technical dream. And of course, it has relative strength. So Microsoft is my pick of the week right now. Obviously, if Powell decides to come along and tank the market, it doesn't matter what your long pick is, it's probably not going to withstand the pressure. But Microsoft currently is my pick, and how I would play it is with a call debit spread. You could probably get the 440, 445s now for even cheaper than what I paid, because it was at around 439.30 when I took it. It's 438.46 now, so you'll get a better price. So that right there is what I'm looking at. We do have a cross below VWAP here on SPY. This is the third time it's tried to cross below VWAP in the past hour and a half. Let's see if this one is sustained or not. I don't, given the low volume and the fact that the Fed is coming up soon, I don't anticipate this being much of a break of VWAP. But you know, when you're dealing with a low volume move right now, you never know. But you know, so just, I would keep an eye on that. In fact, I would probably, if you're going to take the Microsoft trade, you'd probably would want to see a break of VWAP to the upside, and it get confirmed first. But that is my pick of the week. I still like PTLR, but Microsoft becomes my my pick of the week right now.
I've got a trade that I did this morning. Again, I'm trading a small account right now. That way it doesn't really matter one way or the other, but I'm engaged in the market. I want to be trading. I bought 20 of the June 14 4-foot 33. They're currently at about 142, so they're up a little bit. My thought on this is that there's going to be some nervous jitters ahead of the FOMC statement, and there's lots of room to the downside ahead of that statement. So you've got
Which stock,
all these, pardon me?
Which stock?
SPY.
Oh, okay. Gotcha.
So I'm just looking for a market pullback ahead of the FOMC. I feel that these are some really lofty gains, and that there are going to be some profit takers who go, you know, if the Fed comes out and they don't give us what we want, we could see some of these gains evaporate. So I'm just looking for a little bit of a pullback. And because the FOMC statement is pending, these options are going to retain their value pretty well. So I've got this little crack below VWAP. I have been noticing some weakness in financials. Now that is going to change very quickly. You can see JPM here below the 50-day moving average. It is also below AVWAP-E. And you can see relative weakness here. So my thought is that if the Fed comes out and it gives the market all sorts of warm fuzzies, that financial stocks should be able to rebound nicely. Typically after the FOMC statement, you do get a move financial stocks where if by chance the news is negative, we've already got a breakdown in JPM, and it could easily come down and test that 190 level, which is the 100-day moving average. I'm kind of considering ahead of the FOMC, since financial stocks tend to have fairly low option implied volatilities, to do a straddle on JPM using the 192.50 strike price. And let me check where the stock is right now. It's at 193, so I could use that. And that would be 192.50s are the only strike that I would have available to me. And this is actually going to put me more on the bullish side because the stock is up at 193. So the calls are going to be more expensive. I would rather do that the other way around. I'd rather own, and I would rather have this more bias to the downside because we've already got a breakdown in JPM. So that currently is trading for about $3.40. That's something I'm going to continue to take a look at while we do this live event. But that's a trade that I would be leaning towards just for an FOMC reaction.
Straddles and strangles are an excellent way to play these type of volatility moves, particularly when you know the volatility is going to be concentrated in an area. There's something before I forget I wanted to address with everyone because it speaks to a larger issue. And I'm sure everyone knows about it. Let's all talk about GME for 1 minute, just for a second, because you can't go on X, Twitter, you can't go anywhere in the Twit world, whatever, without seeing somebody post about GME. Let me put it this way: there's shit you know and shit you don't know. So obviously, Pete and I advocate for trading shit you know. Now, what do you know? You know technicals. You see them, right? You see price action. Not on GME, any stock. You can look at it. You say, okay, I can see it. And you know what drives those technicals. You know what drives that price action. You know institutions generally are driving price action on a stock. So you can see a roadmap of what's happening. Where are they buying? Where are they selling? How's it doing in relation to the market? All of that. That's shit you know. And the important thing about that shit you know is institutions and other traders have no advantage over you when it comes to that. They're looking at the same chart. The only advantage they have is the ability to read a chart, right? So if you have good chart reading skills and you can calculate relative strength and all of that, nobody's knowing more than you do about that situation. You can now make an informed decision on a trade based on the price action and be fairly certain no one has that advantage over you if you're trading price action because you're all looking at the same price action. So there, you have that on one side. Now there's shit you don't know. Shit you don't know falls a lot under fundamentals. Why don't you know it? Well, because you have the basic fundamental readout. But as we've said many times, and Pete said many times, institutions spend billions of dollars getting information and research that go towards the fundamental read on companies and on earnings that you simply do not have. You don't have it. Why? What does that mean? It means they have an advantage over you. So if you're trading based on that, based on an article you read, based on a post you saw someone make, you're trading steps behind institutions because whatever you know, they know. It's not like you know something they don't, but they know more. So now let's go take a look at GME. Two people are driving GME, Cohen and Gill. These two people, right? They're pretty much driving back and forth, whether they're driving it together or in opposition, whatever. They're the ones driving it. You don't know their motives. You don't know if they have a plan. Perhaps it is a plan to jack the price. Perhaps it is a different plan. You have no idea. So what you're doing at this point is you're putting your hard-earned money into the hands, having faith in two people that could care less about you and have their own goals. You have no advantage there. None. No advantage. And so what do people do? They try to pretend they know. And that's where you start getting these long-ass posts going into this huge DD about the company, about what happens if Roaring Kitty exercises all of his shares, how many shares are available, what will Cohen do, this is it, the stock's going to be at 5. How many times the stock's going to be at 500? Well, guess what? You saw all of that years ago, and it was wrong. It was wrong. A few people made money. Billions of dollars changed hands. And guess what? On the retail side, a few millionaires were made, and everybody else lost money. I am not being hyperbolic when I say that I can't even count how many people have messaged me throughout the year saying they went to Wall Street Bets, and then that's how they got into trading and then lost everything. And I'm talking everything, their home, their marriage, their savings, everything, following these posts that they felt was very convincing about, all this DD about how it's going to go to the moon and blah, blah, blah. And now you're seeing it again. Do not put your money into shit you do not know. Do not put your money into things you do not have an advantage. You want to invest in an ETF, you have an advantage. Why? Look historically. It's going to go up X amount every year, and within 10 years you'll make money. And if that's your plan, great. Price action. You at the very least have an advantage, or you're at least equal to everyone else on that. But when you start going into areas where you're just putting your faith in one or two people and you don't know them, or institutions and you don't know what they know, you're going to lose. It's as simple as that. It's just you're going to lose. So for the love of God, put your money in shit you know. Stop pretending you know things you don't.
And if you look at the GME chart, you can see very volatile trading all over the place. And this is not the orderly price action that we look for. This is not price action that you can predict. And if you look at the range, you've got this candle at $48 and this candle low is around $23. So almost 50% move. Are you going to be able to weather that storm? Probably not. You're going to get in. This thing's moving all over the place and your entry is critical. Well, when the rug keeps getting pulled out from under you constantly, you have no staying power in something like that. And it's the people that are attracted to this play, quite honestly, it's all greed. Oh my God, I can see this stock go from $30 to $300. And that's what motivates people to trade it. You can do much better, and you're going to give a lot of money away trying to trade this. Barry has already mentioned that. I've seen it happen. Consistency and looking for those orderly price patterns. Look at the trades that we've posted over the course of the year so far. We've had maybe one or two losers out of the entire year. And there's a lot of money, a lot of profits being generated.
And I have here someone who clearly drank the Kool-Aid, G36Kers. One, how exactly in Gill and Cohen driving the stock price? When you just mentioned institution drive the price. If you don't think Cohen is institutional, then you're not paying attention. And if you don't think Gill is backed by a fund, you're also not paying attention. If you actually think he had over around $150 million to $200 million of liquidity just to throw into some calls and shares, that's just not possible. Two, yeah, it did go to 500, and you know what happened? People bought it up at 500 because they were told to, and the people that bought it cheap and it went to 500 were told not to sell it. And so they held it diamond hands. It's going to keep going at 500. No. And what happened? It dropped. People lost money. No, I am not making stuff up about Gill or Wall Street Bets. If you have any idea how many lives they have ruined, you would not be saying what you're saying at all. The number of people who have just been decimated because they bought the stock when they were told, they held the stock when they were told, and then they lost everything on the stock. And then all of a sudden, everyone disappeared for 2 years. And then pop, oh, now I'm back. Look, and what happened again? No, Wall Street does not ruin lives, Kate. No, you make your own decisions. You do. And if you could read the price actions, yes, there are flash crashes, 2008, 2010. And if you were an investor and you held, you would have been fine. Those were solid companies that did fine, and there was a housing market crash and people shorted then. But if you held, you would have been fine. And if you were a day trader and were liquid, you would have been more than fine. Day traders made a lot of money during those crashes. You need to take responsibility for your own trades. People make their own decisions. And I'm not blaming them for making decisions on GameStop. I'm blaming the people who are telling them information that simply isn't correct. It wasn't correct last time when the stock crashed back down, and the only people who made money were those institutions that wound up shorting it. And I'm saying they're giving the wrong information this time when people are posting that this thing's going to go back up to 500 or 1,000. It is not. It is not going to happen. Stay away from stocks that do not follow technicals. Now, this guy has drank the Kool-Aid and is obviously bag holding.
Well, I'm not as kind as Harry is, because hey, you want to trade it? Go ahead, trade it. I don't care. Good luck with it. I'm going to stick with stocks where I can accurately predict future price movement and where my probability, my odds of success are much, much higher. I do have
anyway. We only have a actual proven track record across hundreds of stocks, and not a track record of misleading people. But whatever. All right.
I do have a question here. It's lately I get in trouble from bid-ask spreads on options. They look fine when I enter, and then they get huge once we move. How do you scan liquidity to avoid this? Both with or without Option Stalker. In Option Stalker Pro, we've got, and Option Stalker, we have the ability to search for option liquidity. So when we're looking for candidates, that's a search parameter that we use. A value of -2 or higher, goes all the way up to 15, would indicate that the options are liquid. Obviously, if you get to a value of 5, 6, 7, those are going to be super liquid options with tight bid-ask spreads. In general, if you take a look at where all the option bid-ask spreads are across a couple of different expiration cycles at the money.
Unmute for a second, Pete.
You can get a feel for how wide those option bid-ask spreads are. So ideally, you're going to have on a $3 option a bid-ask spread that's maybe 10 cents wide or so. If it's below $3, maybe 5 cents wide. If it's a very expensive option, say $10, you're probably going to have a 20-cent bid-ask spread, even on a more liquid option. And the problem oftentimes with entering option spreads is that you get filled even in a wide bid-ask spread, but when push comes to shove, if the trade moves against you, it is very, very difficult to exit the trade because those option bid-ask spreads widen out. So it's a legitimate question. We use our option liquidity rating to filter out those stocks, and just gauging what the bid-ask spread is going to give you a good idea. Avoid trading illiquid options unless you are going to hold that position for 2 or 3 months. A very, very long-term swing trade. Then you can kind of get away with it, but you do not want to navigate that bid-ask spread more than once. So on the way in, and then you exit the trade. So you do not want to be in and out of something like that. AFRM, I kind of explained how I was having to trade the stock to mitigate some of the position losses on that because the option bid-ask spreads were 30, 40 cents wide. I'm not going to play in that arena. I'll just trade the underlying stock. Let me take a look and see what other questions we've got coming up here. Let's see. What do I think? What is my opinion about brokers removing the buy button back in 2021? Not familiar with that unless it's on some of these meme stocks. Again, best just not to even trade those. If you see stocks like AMC where the stock is taking off, what's new? He's not even making money. I mean, at the local AMC, they have bingo night. They aren't even showing movies. I mean, there's nothing coming out. So there's no justification. Earnings drive stocks and revenue growth. So if you don't have those two things, then it's all fluff. There's some kind of manipulation going on. You'll see it in the price action of the chart. So just avoid choppy stocks. And if you get a blow off rally like this in any stock, you know there's news. You better go find out what that news is. Did they just come out with a new drug? Did they have some kind of litigation that was favorable to the company? What was the reason for this move? And is it going to materially impact earnings in the future? If the answer is yes, then it might be worthy of consideration, but I still would not be buying when it's this far from the EMA 8. Let it come back. And if it never comes back, it's okay. You've got to let these trades go. Focus on other opportunities. And even for GME, if you looked at this little breakout here and this little breakout here above the 200-day moving average and above this horizontal resistance level, okay, you could get long in here. You're not chasing anything. This is your entry point. Boom, boom, boom. You get lucky, take it. See you later. Get out. The fact that these guys were accumulating in here was obvious because we could start to see that volume pop. Up in here, too late. Up in here, forget about it. All right, so we've got the market really just sitting right on VWAP today. So how do we trade the market after the FOMC statement? Well, you don't want to trade the initial reaction, especially when they have a press conference. You're going to see big moves, lots of volatility early on, and the initial move is often reversed the next day. So again, take a nice deep breath. Let's see if the gains from today hold. If the Fed does reduce quantitative tightening today, which is possible, they rolled off from $60 billion a month to $25 billion a month during the last meeting. If they go to zero, with the CPI coming in a little light today, that could fuel a move higher. If the Fed says, hey, listen, we're happy with everything right now. Inflation's coming in, economy is strong. We're going to stand pat. We're going to continue to monitor conditions. I think that some of these gains will be given back, but overall, you've got to respect this market strength right here. Okay, so we're not picking tops. We're not looking for the market to just roll over and play dead. There's nothing that the Fed is going to say today that's going to spark that type of selling pressure. Could we come back and fill this gap in and then start inching back higher again through the course of the summer? Yes, that's very possible on light volume. So you can see there's not a lot of conviction, but that doesn't mean that this is a short. Trying to take a look at some other questions here. Let's see, RIVN. I've got a couple of stock symbols that you'd like me to take a look at. RIVN, it's forming a base in here. So when you've got a downtrend like that, you don't want to be early trying to pick a bottom in here. You want to see a higher low double bottom, which you kind of have in here. And the stock is gradually starting to grind higher. And today it poked out through this 100-day moving average. So you'd like to see that hold. You've got decent reasons to be long in here, but this is generally a fairly weak stock. And let me check the option implied volatility. Pretty decent. A better play would be to sell an out of the money naked put if you really like the stock. And you can sell it below the 100-day moving average, which comes into play at 1166. So if there's an 1150 put and you can get decent amount of money on that, then that would be a play that you would want to consider. And there you can get 54 cents for the 1150 put. That puts you long at $11, which is pretty close to the AVWAP-E. That's how I would play it. If you like the stock, why not take advantage of those rich option premiums, sell an out of the money 1150 put for 54 cents, and you only have a couple of weeks to wait for that expiration. I think I went out June 28th. We've got a couple of holidays coming up as well. We've got Juneteenth and the 4th of July. So that is going to take some of the action out of the market. I think that after the FOMC, we've got pretty much a news vacuum for a few weeks. And I think the price action is going to really start to die off a little bit. Let's see. Question from Dark Lord on taking profits too early. Is there any suggestion that I can give to help you avoid that? Scale out of the position. So when you feel like, oh my gosh, I've got a really nice profit in this trade, but everything seems to be going well. The stock is moving in the right direction. The market's moving in the right direction. Instead of just hitting the sell button and puking out of all of it, sell half of it. Let half of it run. When you eventually get to the point to where you can let that other half run, by the way, it'll be easier to manage because you've already got the warm fuzzy that you need. You've taken some gains on the position. When you're able to let that position run and finally get out when it's starting to show you signs of resistance, or when the market is showing you signs of resistance, that exercise is going to set you up for the next step in the process. And the next step of the process is I'm going to hold the whole position until I see those signs of weakness in the stock and the market. But you're still not done when you reach that point. That step simply sets you up for the final step, which is stock looks good. The market looks good. I'm going to add to the position. And then you get another piece of confirmation where you add to the position. You might have 2, 3, 4 legs to a position where you're adding. Then that's the next level. That's the highest level where now all of a sudden you're starting to add to winning positions. So first and foremost, stop selling all of it and scale out. Leave some of it on. Then identify those signs that told you that the stock and the market were still strong and try and ride that position higher and higher. And then finally, look for opportunities to add to the position along the way.
Sorry about that, Pete.
No worries.
I'm back on. Just had to take a quick call here. Let's see. All right. Someone asked here, why is EMA and SMA as compared to Bollinger better and whatnot? Any core reason why you two have stuck with EMA and SMA? Trying to get a grasp on your question here. So essentially are you asking why we use EMA and SMA, or are you asking why we use them as opposed to Bollinger Bands? So, you know, EMA and SMA, they're moving averages, right? EMA is just a weighted average. So it's weighting, you know, it's an exponential moving average. And SMA is just a basic simple average, which is literally how it's defined. Both of those things are why you're using them opposed to other indicators. Got it. So both of those things are measuring trends in volatility, right? And depending on the timeline you're going to put them at. So if you're looking at an 8 EMA or an 8 SMA, you're looking at where is the current price compared to the current trend, you know, and that trend being defined either by a back-weighted moving average or by a moving average. And EMAs are generally a little bit more responsive than SMAs due to their weighting of the more recent price action. Now, Bollinger Bands, on the other hand, they do adjust, they don't react as quickly to price changes because they're based on standard deviations from the average. So you use the EMAs and SMAs to smooth out the price data, you identify the trend directions. But Bollinger Bands are really used to understand price volatility, and they're used to kind of look at where potential reversals would be. If you're looking at using standard deviations as your point of, let's say, support and resistance, right? You're looking at, one standard deviation away from a mean, plus or minus, is going to be 68% of the price action. 2 is 95%. 3 is 99%, right? And so you're looking at those as buy and sell zones. You're looking at those as price support resistance zones. So you're using them for a different purpose than you're using the EMA and SMA for. You're using the EMA and SMA for to look at where's the trend going, where's the current price compared to the trend. Is the slope of the current price action differing too much from the slope of the current trend as defined by simple or exponential moving average? On the Bollinger Bands, what you're looking at is you're trying to predict a trend reversal. And while I'm not saying that Bollinger Bands are ineffective, they're clearly not. They have their place. I don't use them because I am typically not in the trading business of trying to predict a trend reversal. I go with the trend. So, when you have sort of a motto as a trader, the trend is your friend, and you're going with the trend. Things are up, they're going to continue to go up. Things break resistance, they're going to continue to increase. You're not sitting there thinking, when is this going to stop and reverse because I want to short it? And that is it's a dangerous mentality. And there are some people who can trade like that and do well with it. It's extremely dangerous. So Bollinger Bands, which have their time and place and are fine, they kind of feed into the looking for these trend reversals. You look at them and say, is NVIDIA going to back off, right? Let me look at the Bollinger Bands and see where it is compared to the upper band and so on. And when is NVIDIA going to back off? I'm not looking at it that way. So I'm not a trend reversal trader. I am a trend confirmation trader. That's why I, and I assume Pete, don't use Bollinger Bands as much as others might.
Imaginary Toad Studio asks, when you buy vertical spreads, how do you determine which spread to buy? So on a vertical spread, let's say a call debit spread that we're buying out of the money. For me personally, that's a shorter term trade. And typically those options are going to have higher option implied volatility. So when you're buying an at the money call and selling a farther out of the money call on that, IVs greater than 35, let's say they're somewhere in the 45 range, then you're going to want to do the spread, because by selling that further out of the money call, you're going to actually reduce your risk, and you're going to avoid, not completely eliminate, but you're going to reduce your exposure to time premium decay. And when I do call debit spreads, I tend to do them on a very short-term basis, and I like to have a very strong market. So we go at the money, and we're looking to pay anywhere from 1/3 to about 40% of the difference between the strike prices. And we use weekly options for those. So when I'm trading short-term verticals, that's my preferred strategy. But I have to have a really decent market in order for me to do that. I've got to have a nice breakout here through a downward sloping trend line, for instance, on the market, where you're going to be looking for a bullish trend day. So you want that momentum. You want to make sure that you are correct. You've got a strong market tailwind, and that you've got the right stock that you're also trading that's breaking out to a new high on good volume.
Someone asked me about MSTR. I purposely didn't post this in the One Option chat room, but I did post it on Twitter, so I'll quickly address it. So I was long 2,100 shares of MSTR as of Monday. Then it was long at roughly, I don't know, somewhere around 1650 something. And then, of course, I wake up yesterday morning and Bitcoin crashes and I'm down $140 or something on 2,500 shares. So I'm not happy. I close it. First thing I do is I quickly reverse it and short it. I played around with it for a while, a bit. I made back around $25 of points on it. And then I realized, well, I am still short. I had covered calls, the 1680 covered calls, which I sold for $41. I don't want to be naked those covered calls, precisely because what could have happened today with the CPI. I could either close those and take in $30 of profit, recovering of roughly 55 points of the 140 I lost, still being down 90, or I could wait to see if it re-entered the gap, and the gap was at 1542. So I waited to see it enter the gap at 1542. But it did that before the close. I bought, again, 2,500 shares, one covering my covered calls, which I still have on at 1680. Now I am up roughly $140 on that position. If I get called away, which I hope I do at 1680, I will make $44 there. I will make $140 off. I'll make $144 off of the shares. So that will be $184. Plus I made 25 yesterday. I'll be up 209 points on the trade minus the 140 from yesterday. So I'll be up over, close to 100 points on the trade, 2,500 shares. So that's why I did it. It wasn't a traditional trade. It's more Wiki 2.0, but that's sort of the nutshell explanation on it. Someone did mention INCY in the chat here. While I don't love the volume today, I do love the chart. It is a great chart. It's a good long. I like this. You have this gap up on May 13th. That gap up is held. And then you have it blasting through the SMAs on June 3rd. And it hangs around there, testing it, even as much as yesterday, coming back and testing that 200. And then today, again, it breaks this compression and blasts up again. So that is a nice call out, INCY, like it. And I would think those are pretty good, a pretty good long. What do you think of INCY?
I like it. It's a nice steady grinder, very nice orderly price action. I'm going to do a straddle on JPM as my pick of the week. So I click on the ask. I'm going to do 10 contracts. Again, I'm not taking a big bet here. And I'm going to try and get between the bid-ask spread here. So I'm going to try and buy that for $2.90. I'm going to submit that. And we'll see it's got a average true range of about $3.42 per day. And I feel that either way, after the FOMC, we could either see a nice move lower and this downtrend that's already established could continue. And you can see the relative weakness. Or if the Fed pulls a rabbit out of their hat, the stock could rally up nicely and financial stocks could stage the next leg higher. And they've got a strong market backdrop. So I feel like I've got a situation where both scenarios are possible. And let's see, I'll let you know if I get filled on that.
Sure. Look at Microsoft, by the way. That trade that I suggested when I suggested it would be up right now a decent amount. As it's moved up another, $1.50 since I called that one out. So I hope you took the Microsoft call debit spread. At the moment, you'd be into some decent profit on that position.
Shop. So I've got a question on Shop. Payne Blackstone, Shop. Let's take a look and see what we've got. You like the relative strength. And so this stock is actually in the gap. You can see there's the earnings reaction, big drop, big gap. And so now the stock is pushing through the 50-day moving average. It is into the gap. I would day trade this without a problem. I don't know that I would be swing trading this because these sellers who knock the stock down could come back at any time and knock it down again. So I would be day trading it. That's how I would handle that. Harry, what's your opinion on SHOP?
Well, I mean, I currently hold 25,000 shares of it, and I hold it at $72 a share. So I was down quite a bit. Now it's come back. It's in the gap. It just broke the SMA 50 right now. I mean, if it breaks the SMA 50 and holds there, unfortunately, it still has the 200 to contend with at 68.67. Look, you know, I think you're right on. I think it's a better as a day trade than as a swing because you have a lot of resistance points up there. So unless you're thinking of holding it longer term, only keep your trades short term. Jonathan's talking about DCAing Apple. Let me just tell you something about DCAing. You have to stick to it. You basically, you know, the idea being, look, you're going, irrespective of the price, you're going to buy X number of shares at X time on X date, first of the month, whatever, every other month, however you structure it and you stick to it. You know, every first Monday of every month at noon, I'm going to buy 50 more shares of Apple. Boom. That's it. That's what you do. It's a long-term investing plan where you're dollar cost averaging your stock. If you try to play the price action, this is the one time where price action is going to be your enemy on that. You're sticking to a longer-term investment plan of building a position and averaging the cost on the shares. And you have to do it meticulously, and you have to have a set time and a set schedule that you stick to. If you don't stick to it, think of it as taking some birth control pills. You don't want to miss a dose, and you don't want to get it timed wrong because you're going to get pregnant with the wrong kind of baby. That analogy went off the rails a bit, but I think you see my point. So don't think too much about it. If you like the company and it's a long-term investment, which we don't normally talk about here, then stick with basic DCA philosophy.
So I did step up 2 cents and got filled. Their JPM 192.50 straddle that expires this Friday for a debit of 292. So I am looking for a move in JPM either way. I've got Jake A. You've recently joined One Option and your win rate's gone way up. Glad to have you aboard. Glad to hear that. I've got a question on how my book is coming along. Well, it is summer, and I do like to play in the summer, so has not been coming along, but I have renewed energy, and I'm going to try and crank out some articles in the next 2 months or so, and then I've got the final push this fall. So very tough to get motivated to write when it's nice outside.
So here says, the wiki says having a SPY, having an inside day is a low probability trading environment. Usually is a low probability. There are exceptions to that, but okay, let's go with it. What about tickers that are having an inside day? Typically, yes. I mean, if a ticker's having an inside day, it's not the one that should be grabbing your attention. There, again, are exceptions. For example, what if SPY is the market dropped 8 points, right? It's a huge market drop, but stock is having an inside day. Well, that's going to be some strong relative strength there for that stock, isn't it? Because it shouldn't be having an inside day. Or SPY is up a lot and it's having an inside day. Well, again, that's going to be some strong relative weakness. It shouldn't be having an inside day. So, really, again, it has those are general rules that if you stuck to, you're going to be right 90% of the time. But bring it back to the market. It's about insights on stock more. How is stock performing compared to the general market? And the market weights the stock, right? So if the market is up X percent and is moving up by X rate, the stock should be mirroring that at base level. Anything beyond mirroring that, meaning it's stronger, is relative strength. Anything less than mirroring that is relative weakness. And that tells you that even though it should be doing X, it's doing Y. And the only way a stock would do Y when it should be doing X is if institutions are in there doing something counter to what the market is doing, or if the market's up, doing something more proportionally than the market's doing. And that is what you're looking for, right? So again, inside day is a decent rule to keep, because you're not going to go wrong with it. You just might miss some opportunities. So look more towards relative strength, relative weakness, but your point is well taken.
I do have a question. I can knock two birds out with one stone here. One question is, how do I like TSM? The other question is, do you never buy a stock that has distanced itself from the EMA 8? Or do you make exceptions? I tend not to make exceptions because you've got too much downside risk, and sooner or later, the stock is going to pull back to that level. If it doesn't, I have the mindset that I'm going to let it go. I missed that one. That's okay. There's 3,000 other stocks, 5,000 other stocks I can be watching. I don't have to reach, because typically when you reach and the stock is above the EMA 8, oh, here it goes. Oh, it looks so good. I have to buy it. Woof. It pulls back. It's gotten ahead of itself. And when you buy here and the stock comes down to here, you feel like a real dummy. And the object is not to put yourself in a position feeling like you're a real dummy. So pulls back. Okay, now I like it. I watch it. Oh, it's actually pulling back below the EMA 8. Okay, in here I can start thinking about taking a position in it. But up in here, you like the stock, right click. This has saved so many people so much money. You can see LRSI is above 80 on a D1 basis. Right click, LRSI. Use a D1 basis. When LRSI goes above 20, which it is above 20 right now, but our servers know that it's got to go below 20 and then above 20, then I will get an alert. I set that alert and I don't even think about it again. Nice looking stock, not going to buy it unless I get a dip. You can also click GTC, click on the bottom of this candle. Now I have an alert. When the stock does pull back, I'll know that it's closer to the EMA 8, and this will give it a chance to catch up to it. If it just keeps going higher, go. I don't need to chase you.
Keep in mind, yes, you can eyeball this shit. I mean, you don't have to, do pre-calc here and figure out and geometry and figure out the slope and algebra. You can just look, put the EMA on the chart, see the slope of the price action. If the slope and the slope are matching each other, if it's curving up and it's curving up, you're fine. The moment it gets extended, the moment you have this sharp slope up in the price action and it's deviating from the slope of the EMA, you're not fine. That's usually going to be also because it's a news-related event that's happening either in the market or with the stock, and you can expect that it'll probably pull back. There are some exceptions to it. NVIDIA continuously gets extended from its EMA, and that doesn't seem to stop it. But NVIDIA, you don't want to base your trading on the one stock exception to the rule, and NVIDIA has been an exception to the rule ever since. By the way, sorry, yes, ARM, I saw. I do like ARM. ARM is just a little bit more volatile than most other stocks in that sector, but there's no denying, if you look at the chart, it is, just a ever since April 19th, this thing has gone up almost 100%. And it is a nice, clean, orderly increase. This is not a parabolic increase. So this is what I mean by not getting extended from the EMA. You can look at the price action on ARM, and even though you've had almost a 90% rise in price action since the beginning of mid-April, you haven't had much of an extension because you're getting an orderly increase here. You're getting these buys into the gap. You're getting gaps up. You're getting these holds at the SMAs. You're getting breaks of the SMAs, another more compression, then breaks again, then more compression, then breaks again. So, this ARM is a strong stock. I tend to avoid it because it's volatile, but there's no denying that the chart looks strong. I think that's all I got on my end.
That's all I got on my end, and I'd like to take a break before all hell breaks loose.
Yeah.
Another 50 minutes. So I think we're going to conclude today's video. If you had any questions, I'm sorry if we haven't gotten to them, but please make sure to post your questions on the live event video recording that we post, and then I'll be able to answer them there. Also, next Tuesday, I'm going to do a special live event with Rajul. He is a member of ours, and he actually has his own YouTube channel where every day, just for his own purposes, he's not doing this to get a bunch of subscribers. He is going in and he's doing the same type of analysis that I do in my Sunday recordings. He's reviewing his previous pick, he's looking for new picks, and then he's doing his market analysis. And so I'm going to have him aboard Tuesday, and then we'll do our normal Wednesday live event as well. So if you're interested in seeing what a novice trader's perspective is and kind of how they're going through to hone their skills, please attend. I think it's going to be very enlightening for you. He's also got a pretty interesting journey that he'll also be sharing.
Great.
All right,
send me that link, Pete. I'll post it up on my Twitter.
All right, awesome. Everyone, trade well. Watch out for the FOMC. JPM straddle is my trade, and Harry has Microsoft. So we'll see how these turn out.
Yep. All right, everyone.
All right.
Trade well.
Trade well. Thank you.